I now hand the conference to Mr. Prashant Nair from Ambit Capital. Thank you, and over to you, sir.
Thank you. Hello, everyone. On behalf of Ambit Capital, I thank the Laurus management for giving us the opportunity to host their Q2FY22 earnings call. On this call, we have Dr. Satyanarayana Chava, founder and CEO, Mr. V.V. Ravi Kumar, Executive Director and CFO, and Mr. Vivek Kumar, Senior General Manager, Investor Relations. I now hand over the call to Dr. Satya for his opening remarks. Over to you, sir.
Good morning, Prashant, and good morning, everyone. Thank you for joining us for our Q2 and H1 FY22 results conference call. We are pleased to have this opportunity to update you on our progress and answer your queries. I hope everyone and their family members, colleagues, friends are safe during this COVID pandemic. We continue to witness normal operations across our manufacturing units, R&D centers, and at our corporate office. At the company, we are committed to protecting health and well-being of our colleagues and their families. We continue to implement rigorous safety and hygiene measures across all locations without any complacency. We continue to conduct regular testing for all the employees and provide work flexibility wherever possible. We are very thankful to all our colleagues for rising to this challenge and ensuring business continuity. We are excited to announce Laurus Synthesis Private Limited, which is our CDMO subsidiary, has signed a multi-year supply contract with a global life science company during the quarter. The deal entails complete drug development and manufacturing for a portfolio of niche APIs. Under this agreement, LSPL will use part of the existing capacity to manufacture and supply APIs and also set up a dedicated manufacturing site to cater to the demand. Part of the capex will be funded through long-term commercial advance, apart from sponsoring development costs. We believe this development and manufacturing agreement demonstrates our capability and marks a significant step towards our evolution as a valuable partner for global life science companies. We are also seeing additional opportunities in the CDMO space from few existing as well as new partners who are looking to diversify and de-risk their supply chain base. I would also like to briefly touch upon the recent manufacturing challenges in China, which we believe can have interim challenges to pharma industry, including fluctuation in the cost of API, availability of raw materials, and supply chain disruptions, along with higher logistics costs. We are closely monitoring the situation relating to this while taking relevant course correction to fortify our business continuity and sustainability. Coming to our results, Q2 numbers have been slightly weak due to transient impact of channel destocking of various business. However, for H1 FY22, the operational performance was resilient overall as we continue to demonstrate healthy business mix and profitability. Our sustained traction in FDF and CDMO business was key drivers for the growth so far, and we expect the same divisions will continue our growth in the future as well. We are well on course in our journey to expand and intensify our diversification plan as we propel our growth in the coming years. We remain affirmative on our aspirational revenue target of $1 billion by FY23, and this will be supported by several approvals anticipated. And we made good progress in creating capacities across our core business segments to reach this aspirational goal. Moving on to our Q2 FY22 revenues, we achieved 1,203 crores, showcasing a growth of 6% year on year. When compared to H1, we achieved 17% growth year-on-year. To begin, I would like to share key updates on our formulation business. The formulation division reported a revenue of 495 crores, a healthy growth of 10% year-on-year for Q2. The contribution from the formulation segment has improved during the first half to 41% when compared to 35% in the financial year FY21. Coming to the LMIC business, we are seeing some across the region. During the quarter, we launched a triple combination of using tenofovir alafenamide after obtaining in-country approvals, and we expect a gradual ramp up for this product. Apart from the ARV LMIC business, we have seen good growth in developed markets in North America and EU. We are seeing a healthy market share increase in some of our existing portfolio in these markets. We continue to leverage our front-end presence in US for new product launches. During the quarter, we filed 2 ANDAs and 4 in the first half of FY20. Cumulatively, we have filed a total of 30 ANDAs. Out of these, we have 9 final approvals and 9 tentative approvals. In Canada, we have 11 product approvals, of which we launched 5, and we intend to launch 2 in the next 2 quarters. In EU, we have validated the 2 products as part of the contract manufacturing agreement with a partner. We expect a significant upside in FY23 from these products, and we are also creating capacities to cater to the demand in the new formulation building. Medicine Patent Pool and Merck entered into a licensing agreement for molnupiravir for low and middle-income countries. As you are aware, Laurus and NPP have a very long and successful partnership in various HIV and FC drugs, and we will approach NPP for molnupiravir license as well. With a very good visibility in FDF segment, we continue to invest in our capacity expansion. As part of the debottlenecking, we added 1 billion capacity during the first quarter, and additional brownfield expansion on the same site is going to add significant capacity in a phased manner, starting from Q4 FY20. With this, we will achieve a 10 billion unit capacity in our formulation site. We continue to allocate critical resources to our research initiatives and investing in portfolio based on complexity and scale. So far, we have immediate release delivery forms. We graduated into developing sustained release forms and some complex generics as well. This overall R&D spend to the sales for the quarter and H1 was at 4% of our revenue. We have a total of 66 products in the R&D pipeline, either on review or on development, having a very significant addressable market size. We have filed 30 ANDAs in US, 11 dossiers in Europe, 15 dossiers in Canada, 8 with WHO, 4 in South Africa, 4 in India, and we have filed several in the other African markets. Out of the 30 ANDAs filed in US, we have 14 Para 4 filings with 10 positive file opportunities. Our approach remains product specific and not market specific. That was very visible in our filings across the regions of Europe and Canada. When it comes to generic API, our antiretroviral business during the quarter was weaker than expected and declined 11% year-on-year to 339 crores. Sequentially, the drop is higher due to continued demand stabilization in the channel, as indicated in the last quarter itself. These is expected to stabilize in Q4. We continue to maintain leading market share in the products that we sell, so there is no concern with respect to market share or the cost of the product or the capacity of the product. When it comes to oncology APIs, we see good traction in the sales, although there is a decline in the Q2. That's not because of business challenges, it is only because of deliveries expressed to the customer. We see by the end of the year, oncology will see a growth when compared to the FY21. As you're aware, the company has one of the largest high-potent API capacities in India. We also added a new capacity during the first half of this year, and we are further expanding the capabilities in high-potent manufacturing in Unit 4 located at Visakhapatnam. Our aim is to strengthen global leadership in some of the existing products by focusing on capacity and backward integration. In the generic API segment, other APIs predominantly constitutes of cardiovascular, diabetes, and some asthma products. Recorded the 8% growth year-on-year, and there is a decline of 20% in the first half of the FY22. This decline has nothing to do with the business opportunities. It is only the scheduling of the deliveries by CMO partners. And we do believe this segment by the end of the year will see significant growth. When it comes to the CDMO synthesis business, we maintained a very strong growth and delivered 34% year-on-year during the quarter to achieving 155 crore sales. For H1 FY22, CDMO business grew over 60% year-on-year. As I mentioned, our contract with the global life science company will take the division to much higher heights in the coming years. Strong growth year-on-year was led by sustained new client addition and increased businesses from existing customers also. We are pursuing several active projects in the late-stage chemical programs, and as we indicated, there are 4 products we supply on a commercial scale. We are also doing capacity expansion for this division, and we commercialized LSL Unit 1 at Vizag during the quarter 1. This will cater to the exclusively CDMO activities for the division. Our greenfield investment to set up a dedicated R&D at Genome Valley, Hyderabad, will be completed by FY23, by end of FY23. And we are also putting up 2 new manufacturing units at Vizag under the subsidiary. These units are expected to be operational by FY23, and the commercialization will be done during FY24. These sites will have capabilities to handle steroids, hormones, high-potent molecules, apart from very large volume molecules. When it comes to Laurus Bio, this division achieved sales of 26 crores for the quarter and 40 crores for the H1 FY20. On a quarter-on-quarter basis, the business is scaling very well as per expectations and has grown over 80%. That is mainly due to availability of the new fermentation capacity. During the quarter, we have commercialized using the second fermenter, taking the total fermentation capacity to 90 KL at R2. In the remaining capacity, 2 fermenters are under qualification and are expected to get commercialized before December. The capacity will be used for large-scale CDMO of food proteins. We also going for expansion at R1, adding a new very large R&D block, and also already started installing some balancing equipment at R2. This will be done by September 2022. We are also in the process of acquiring additional land to meet our customer demand in the recombinant food proteins. At Laurus, our focus on ESG, quality and regulatory compliance, to drive sustainable growth and further bolster our pipeline. This will aid our journey towards our vision, apart from our strengthening core values. Manufacturing capacity is required to achieve our aspirational revenue of $1 billion in sales by FY23 are already available with us, and some manufacturing facilities will be qualified by March 2022. If you receive ANDA's approval as we anticipated, we don't see any challenges in achieving our aspiration target of $1 billion revenue by FY20. With that, I would like to hand it over to Ravi to share some financial highlights.
Thank you, Dr. Satya, and very warm welcome to everyone for our Q2 and H1 FY22 earnings call. The total income from operations for the quarter is at 103 crores as against 1140 crores, showcasing a growth of 6%, whereas for the half year, it is 17% growth. Gross margin for the quarter is around 56%, which is equal to the corresponding quarter. Our EBITDA is at 348 crores for the quarter with a margin of 29%. Our EBITDA for H1 is 748 crores with a margin of 30%. So we remain confident of achieving close to 30% EBITDA for the full year. Our diluted EPS for the quarter is 3.7, 3.70, not an annualized basis. Whereas for H1 it is 8.2. Our ROCE is at 29% on annualized basis. So on the back of sustained operating leverage across all our manufacturing units. On the capex front, we invested close to 242 crores during the quarter and 518 crores during H1. We remain on course to strengthen our position as a cost-effective integrated pharma player. We are investing in backward integration efforts, in making intermediates, creating further APIs and FDF capacities. As you are aware that we have embarked upon a significant growth capex of 1,500 to 1,700 crores for FY22 and 23 in 2 years' time. We want to update you that most of the investment across the key projects on track, and we expect to be in the similar range for the 2 years. And we will give you an update by end of the financial year, so where we will be for the next year. Given that we are at the start of the festive season, we would like to wish you all a very happy and safe Diwali and prosperous Diwali for all of you. And with this, I would request the moderator to open the lines for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudarshan Padmanabhan from JM Financial. Please go ahead.
Yeah, hello. Thank you for taking my question. Sir, my question is, to understand the situation more as far as the, raw material availability is concerned. I think across the industry people are talking about it. And from what I understand is there has been a substantial increase in the base material in the second quarter and further increase, say, in the month of October. So in this backdrop, and given that we have also been backward integrated quite aggressively, how much do you think that incrementally in the third quarter you see issues both in terms of price escalation and availability for us?
Thank you, Mr. Padmanabhan. The raw material price increase is especially visible in the solvents, and utility costs also gone up significantly. The increase in these prices will be visible only 3-4 months from the day we start buying the solvents because of the inventory in the pipeline. As you are also aware, the gross margins for the quarter were very healthy when compared to previous quarter. That was primarily because of higher revenue contribution coming from synthesis and FDF. And in the case of ARV, most of the ARVs are under a long-term contract to other formulators as well as in the FDF space. We will maintain similar prices to our partners. I am not saying same prices. We'll maintain similar prices. And we have built significant inventory. You might have seen our inventory also gone up by close to 300 crores. That was primarily because we are having a lot of ARV inventory. Actually, that is good for us because this ARV business will continue to boom because of moving from 30s to 90s. We do believe a lot of destocking is happening in the various countries. Once that issue is over, the ARV business will continue to be back on track, and our inventory will certainly help us to service the demand with our customers.
Perfect. And with respect to China, how much would be the dependence on China, sir? And in the other businesses apart from ARV, is it possible for us to pass it on?
The dependency on China right now is close to 50% for us. So 50% of raw materials we buy from China. And we don't buy any intermediates. All intermediates are made in-house. So that way, we are insulated from the fluctuations to a great extent. Our challenge is only to monitor the prices of solvents, which is a global phenomenon, not limited to a country. Other than that, because of our initiatives and also capacity creation for the backward integration, we are in a better position than people who import from intermediates and buy APIs from other countries.
So my second question is, two things. It's basically two parts. One is, we are feverishly adding a lot of capacities and we have signed this long-term contract on the CDMO space, which lends a very good comfort as far as future growth is concerned. The second is, if I break the cost, below the gross margin, because of the lower than expected ARV sales, we have seen some kind of a negative operating leverage. And also, I would assume that the transportation cost, as you said, would be higher. So as we move to the second half, number one, do we see, say, an FDF or, the CRAMS business picking up and offsetting some kind of ARV loss? And how do we see, second, is cost control? Is there a possibility of absolutely controlling certain costs, given that we are facing some of these issues?
Voice was not very clear, but if I go grasp what you were asking, see, the second half, the ARVs will pick up. Especially the Q4, we don't see any challenges to go back to the Q4 of FY21. So we are very confident, and we are also confident because of enough capacities we created, enough inventory in the pipeline for us. We are very confident to service the ARV growth in Q4. Coming back to your question of gross margins, see, our gross margins are very healthy. 30 basis point reduction when compared to the quarter-on-quarter and 100 basis points variance to the year-on-year. So we are not having any concern to maintain that gross margin despite of these challenges because of shift in revenue contribution coming from FDF as well as synthesis business.
I am talking about margins below the gross margin, sir. That is the operating leverage. So again, should the volumes more than offset the kind of drop in ARV in the second half? And specifically talking about, the cost, the other expenses. So is there a way where we can control that cost?
See, in the Q2, we had a negative leverage actually. We have less ARV sales, we produced more in the APIs. So despite of having higher gross margin, same gross margin, we had a lower EBITDA. That is because of de-leverage in operations, because without selling we produce more.
Mm-hmm.
So would
that improve in the second half?
Sudarshan, your voice is not clear. Can you just rejoin?
Okay, sure.
Yeah, thank you.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Sir, on the FDF front, while we had capacity expansion and even new launches happened during the quarter, but quarter on quarter, in fact, the FDF sales have declined a bit. Can you explain that?
The decline in FDF sales is not significant. See, quarter on quarter, Q1 we did 521 and Q2 we did 495. So it's not significant. If you look at year on year, we did from 450 to 495. And we don't see any challenge to utilize our additional capacity in the next financial year. As we mentioned, we are creating capacity to service our demand in FY23.
Okay, so you mean to say that FY22 would be more or less at the similar run rate as the capacity, or rather commercialization will start having fruits in FY23?
New revenue coming from the brownfield expansion in the site will come from FY23. The debottlenecking capacity will come and in the partly came in H1 and fully in H2. Actually, the coming from Q3 onwards, Q3, Q4, our formulation lines are running at very, very optimum capacity.
Got you. And just extending to that, so with this, your lines operational fully, given that we had the kind of, so other expenses and the employee cost to also then, increase in line in the upcoming quarters?
Maybe, I think, slightly maybe higher side, Tushar.
We started recruiting people for the brownfield expansion already. But H2 will be better than H1, we believe, in formulation, because we have more visibility in what we are going to produce in Q3 as well as Q4.
Got you. Secondly, while you have alluded that 50% of raw materials are procured from China, but how has been the price changes for these raw materials which are procured from China, let's say over past 6 to 9 months? What percentage approx increase would have happened?
See, as I mentioned, we are more concerned on the volatility in the solvent prices rather than on the intermediate starting material prices from China right now.
And this solvent should be contributing to what percentage of your total raw material cost?
About single digits. So, yeah, in the single digits.
Understood. And just lastly, on capex, while we have almost about 580 crores in first half, and given that it's on 1500 to 1600 over FY22-23, so just trying to understand how much capex would you be doing in the second half FY22?
Tushar, actually, what we are saying is the whatever guidance we gave, 1700 crore, majority will be there in the current year itself.
Oh, okay.
See, in the first half, whatever 518 is there, that includes the large portion of land what we have acquired for both subsidiaries as well as for the parent.
Understood. That helps. Thanks a lot.
Thanks.
Thank you. The next question is from the line of Dilip Sahu, an individual investor. Please go ahead. Mr. Sahu, your line is in talk mode. Kindly go ahead with your question, please. As there is no response from the current participant, we move to the next question from the line of Ankush Agarwal from Surge Capital. Please go ahead.
Yeah. Hi, Dr. Chava. Thank you for taking my question. So firstly, in Q2 of last year and also in Q3 of last year, you had stated that the rise in our ARV business is not because of channel stocking at our customers' end. But now you're seeing channel destocking at our customers' end, which you expect going forward as well. So what explains this contrast?
Can you just repeat the question?
So last year in Q2 and Q3, when our ARV business jumped quite a lot, you had mentioned that this rise you believe is not because of channel stocking at our customers' end. But this quarter, you're seeing channels destocking at your customers' end, and going forward, you expect the same to play out for at least a quarter. So what explains this contrast?
Channel stocking, yeah. Last year, when we have a more revenue, the question is whether the channel stocking, someone asked the question of channel stocking, we said no. But now why it is channel stocking? That is the question, right?
Yeah.
So one reason is, actually there are two reasons. One is most regulators and the country health authorities moved from multi-month dispensing. From 30s to they moved to 90s. So suddenly there was a uptick in the number of units they procured to give to multi-month dispensing. That was one. And then partly shift from FRL-based regimen to JLW regimen, as we also left some channel, the inventory of FRL-based regimen, it took some time for that regimen inventory to be dispensed. So these two happened in the last 6 months.
Right. So do you think the ARV business can scale back to those kind of numbers going ahead?
From Q4 onwards, we do believe we'll go back to the Q4 of FY21. Yeah. So we're very confident on that.
Right. And so, secondly, just a clarification, you mentioned that on the ARV business side, you're not expecting to pass on the prices, like the cost price, and you will be maintaining similar prices to our customers. Was it?
We do have the ability to pass on part of the cost increases to the customer. We are already talking to them. For the new orders, what customers will place. For the existing orders, what they have placed, we are honoring at the same prices. That is the kind of reputation we built in the industry. If the orders are placed with us, and we never went back to customer renegotiating. For the new orders, we are already negotiating, and we will certainly pass on the price increases, partly, if not fully.
Right. And this is for both ARV, API, and FDF business, right?
That's in the API space, not in the FDF.
Not in the FDF. Okay. Got it. Thank you.
Thank you. The next question is from the line of Krish Mehta from Enam Holdings. Please go ahead.
Thank you for taking my question. So I had two questions. The first is, could you share the number for the share of non-ARV revenue for the quarter?
Non-ARV API revenue for the quarter is
23 plus 1. What do you
now, in the API space, out of 527 crores, 36% of API revenue came from non-ARVs.
And for the entire business?
Entire
business.
For the entire business, including FDF?
We are not.
I don't have a number right now.
We are not disclosing that.
Okay, and I just wanted to clarify on the capex for Q2. Could you please just restate that number?
Krish, can you please speak louder? It's not very clear.
Sorry, for the capex for Q2, could you please share that number again?
You are asking capex for Q2?
Yeah.
CapEx for Q2, what we are saying is the majority of 1,700 crore, what we have guided for the 2 years, will be spent in this year. Maybe in close to the maybe the full year we may spend around 1,000 crore.
Okay. Thank you.
Yeah.
Thank you. The next question is from the line of Harid Ahmed from Spark Capital. Please go ahead.
Good morning. Thanks for the opportunity. On the formulation side, we are expecting to complete the brownfield expansion of 4 billion tablets by the end of this year. So, can we expect revenues from these expanded capacities from early FY23, or should we wait for a period of filings or site transfers and inspections before we start commercial supplies from this expanded capacity?
It will start giving revenues from FY23 itself. We don't need any new site approval. We are having we're planning to have inspections required in Q4 FY22 itself. Already scheduled by the authority. So we don't see any challenges of product approval or regulatory approvals to utilize our brownfield expansion in the formulations.
Okay. And then again on the formulation side, can you talk a bit about our filing strategy in terms of what are our priority areas? Will we go beyond oral solids, or will we stick to products where we have strong API capabilities? And then how should we think of R&D spends in this context?
Can you just little bit more elaborate on the question? I didn't get exactly.
So currently our filings are almost entirely in oral solids. So will we think of going beyond oral solids into, let's say, injectables and other dosage forms?
Thanks for clarifying the question. As of now, most of our commercial products are immediate release. Only one is modified release. We are going into the modified release dosage form file, and we are also developing more complex generics, which we will file one by end of FY23, another one in 24. Apart from the oral solids, we also more clear on going into sterile manufacturing, and our R&D will be ready by end of Q4. And for that, we started recruiting talent, and we are building a portfolio and some partnership too. So we decided to go into other delivery forms, but into injectables.
Okay. And last one, if I may. So on molnupiravir, we mentioned that we will look at getting a license from MPP, like we've done in the past for other products. So what are the next steps, and what's the kind of timelines that we should think of in terms of licensing?
The timeline is only expectation. So FDA should approve in their 30th November meeting, and then the local regulator DCGI has to be approved. All our files are pending with DCGI for approval. We do hope they will take a decision after FDA approves by end of November. And if approval comes, we are ready to take the opportunity.
And it will be supplying in India as well, along with the MPP designated regions.
We do believe that many people will approach MPP for licenses. As I mentioned, we have a very long successful partnership with MPP. Probably very challenging to say whether launch will happen in this quarter, but definitely we do hope the product will be launched in across the low middle income countries by January for sure.
Thank you very much, sir. That's all from my side.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, morning. Thanks for taking my question. Dr. Chava, you mentioned in your opening comments about the $1 billion aspirational target for FY23. You're saying that you don't see any issues in achieving that, subject to the timely US FDA NDA approvals. Sir, so is this target for us contingent on some few specific approvals, largely contingent on that, which makes it sensitive to these?
The majority of the capacity what we're getting in the formulations will be placed for to our partner in Europe, where they have done site transfers already, include our site in their base here. Files are under review. So regulators already scheduled a visit to our site in the first quarter of the calendar year next year. We don't see that will be a obstacle in commercializing our products.
Okay. And sir, on the US FDA that you mentioned, are there any large approvals which are pending approval from the FDA that that may impact our target?
There were 3-4 approvals pending, but not because of facility inspection. There were queries on the DMS and ANDA, but in the normal course only. So we do expect significant approvals coming in next 6 to 9 months.
And sir, on the synthesis business, 2 questions. One is on the contract that you announced that we've signed up. So by when does the full impact of this contract start to get visible, and how meaningful can it get? What is the current size?
We can't give you specific, but we are investing already with existing investments. We are investing close to 450 crores in that to service that contract, and we do hope full potential will be realized by FY25.
FY25. And sir, apart from this particular contract that we've signed up, how is the traction on the other potential partnerships or pipeline products?
Very good, actually. So we were very bullish on our CDMO division than we were bullish on previously. We were bullish previously, but now we are even more bullish on this division. That is the reason we are investing more into this division. We have very interesting projects in the pipeline, and we are adding more resources and R&D also for the division. So the division do very well this year as well as in the years to come.
Okay. And so these would be again, as you mentioned, in the category of steroids and the high potency molecules, largely these business that we're getting.
It's a combination of. See, we have the largest capacity to handle high potent. That became our unique offering and large volume. So it's a combination of potent molecules as well as large volume molecules. It's a combination of those.
Okay. Thank you.
Thank you. The next question is from the line of Cinderella Carvalho from Centrum Broking. Please go ahead.
Thanks for the opportunity. Sir, just to take on the synthesis side, earlier you had mentioned that we have 2 molecules in phase 3. Could you help us with some more details and any update on those and the outlook ahead?
From last quarter, this quarter, there is no further update from those 2 molecules. They are still in the phase 3. No further updates available.
Okay. And sir, if we understand the raw material inflation, which is ongoing, what is our sense as of now, and how do we have any mitigation strategy, or these being the basic solvent kind of variety, we have to wait until this storm settles down? So how should we look at these the raw material inflation scenario as of now, and what is your sense on it, if you could help us with that?
The mitigation strategy is to backward integrate, to make intermediates that we have already achieved, and the other mitigation strategies we have very good inventory so that we will not be vulnerable to the disruptions in supply chain. That also we have done. The other one is we can't make solvents and reagents. So that's where a lot of volatility we have seen, and we are closely monitoring, and if there is a significant volatility, partly we will pass it on to our customer for future orders for sure.
But sir, on the backward integration side, would we need any additional capex, or is it something that you're planning, or is it already done?
Already done. We don't need. We are not investing additional capex to do this, because this is part of our strategy which we are which we have executed or executing right now.
And so, just to carry forward this, if we look at any ARV tenders which would be upcoming with these inflationary costs, also would be part of those tender pricing? Any updates, any thoughts on that, sir?
These tenders are multi-year tenders, so we have to wait and watch on how the pricing will move.
Right. And sir, if we have to take the ARV business, how is the volume traction, any demand scenario change that you are seeing, given the slight weakness that we have observed?
Demand was less during the Q1, Q2, and we do expect by end of Q3 the demand will pick up, and Q4 we do believe it will be quite normal. Yeah.
Okay. And sir, one clarification on molnupiravir with NPP. This would be for the LMIC market, right? And on the formulation side, if I understand it correct?
Yes, it's for the LMIC markets for formulations. Yes.
Right. And the API would be sourced from Merck's exclusive supply, right?
I will get you last your point.
I'm saying the API for molnupiravir will be sourced from Merck's entity, or we will be also working on the API side for the formulation?
As part of the agreement, API manufacturing can also be done in-house, and we will do in-house.
Thank you. The next question is from the line of Samir Dosani from Carnelian Capital. Please go ahead.
So just wanted to clarify one thing. So we have seen that there exists a technology in the sense that we can do, there are drugs which can be given by way of injectables, which replaces your 3 to 6 months of tablets that we are giving in LMIC region. So do you think that technology is going to impact us, and what is our risk, mitigation strategy in this? This is relation to ARV drugs that we have, right? So.
I'm sorry, we couldn't get your question.
So for the ARV drugs that we give in LMIC region, there is already technology existing where you can give an injectable that will suffice for 3 to 6 months of tablets that are given to all the patients, right? So do you think that is a big concern, and what is our risk mitigation strategy in this sense?
Amir, your question is not clear. Can you please speak close to the microphone?
Mr. Samir? Sir, may we request you to rejoin the queue once again, sir?
Okay.
Till then, we move to the next question from the line of Aditya from Carlyle. Please go ahead.
Hi, thanks for the opportunity. I just wanted to clarify on a couple of things. What percent of the raw material costs would the solvents be?
Our purchase of solvents in the overall cost is, I would say between 5 and 10%. Is a single digit. So, yeah.
Sorry, 5 to 10%, you said, right?
Yeah, depending on the product. So, it's between 5 and 10%.
Sure. And over the last 6 to 9 months, what is the kind of inflation that you have seen in those prices?
The significant increase in price happened in the last 2 quarters only. Yeah. So some solvents went up by 10%, some solvents went up 50%, some solvents went up by 200%. Yeah.
Right. Okay.
Some solvent prices have gone down. For example, ethanol prices were quite stable, rather it was a little lower than what we anticipated. Some solvents went up significantly, which are petroleum derived went up significantly.
And the GM impact of this price increase, according to you, will be visible with a lag in a month or two, given that will get built into the inventory, right?
If you look at, as we are saying, the solvents contribute, let's take a number, 6%, and 10% of it is 0.7%. It's 20% is 1%. So I think this will not disrupt the overall gross margin level. This may influence, but this will not disrupt.
Sure. And on the formulation side, are you seeing any cost pressures as well?
So majority of our revenue coming from LMIC, ARV, and contract manufacturing to European partner, sales in Canada and US. Fortunately, we haven't seen much pressure on the pricing as yet.
All right. Thank you.
Thank you. The next question is from the line of Gagan Tareja from ASK Investment Managers. Please go ahead.
Yeah, good afternoon. Am I audible?
Sir, if you can speak closer to the handset, please. Your voice is not audible.
Yeah, am I audible now?
Yes, sir, this is better.
Okay. So, sir, my first question is around the API contracts that you have talked of in your presentation. Are these off patent or are they on patent and you're going to supply for them?
It's a combination.
Okay. Sir, since a lot of your foreseeable future opportunity for growth comes from one, this contract, and the other is the EU supply contract, which I presume will be an off-patent formulation contract. Are the margin profiles for these supplies comparable to what you have currently, or are they different or markedly different from that?
No, we don't see any margin contraction by entering into the CMO partnerships, whether in formulation or API. We don't have that challenge. Yeah.
Thank you. The next question is from the line of Nimish Mehta from Research Delta Advisors. Please go ahead.
Yeah, thanks for the opportunity. Just wanted two clarifications. So you mentioned that the formulation sales will come back to the Q4FY21 level, but that is roughly about 430 crores, which is lower than what we have reported right now. So does this mean that we are seeing...
Your voice is not clear. We couldn't understand.
Yeah, is this better now?
Slightly better, but...
This should be much better.
Take the phone off speaker, please.
Yeah, this is better?
Yeah.
Okay. So, yeah, I just wanted one clarification on the formulation sales. You mentioned that our sales will come back to Q4 FY21 level, which is actually much lower than what we have reported today. So Q4 FY21 was 430 crore versus say 495 crores we have reported.
When I said we'll come back to Q4 FY21 number, that's for ARV API, not for the formulations.
I see. That's ARV API. Okay. I'm sorry. Yeah. So, any broad guidance on the formulation sales on the same front?
Formulation sales, if you look at our Q2 itself, we have done much more than our Q4 FY21. In Q4 FY21, we did 430 crores. In Q2, we have done 490 crores. So we are not comparing our formulation numbers with the Q4. So, as I mentioned, the Q3, Q4, we do hope to do well in the formulation side.
Okay, understood. The second question is, again, some clarification on the raw material pricing. You mentioned that we are not really exposed to pricing related to intermediates, but we are exposed to solvent pricing. So does this mean that we are kind of fully backward integrated on the intermediate manufacturing?
Yes. So, we can make clear, we don't buy any intermediates. Everything is made in-house.
Okay, understood. Thank you very much.
Thank you.
Thank you. The next question is from the line of Harith Ahmed from Spark Capital Advisors. Please go ahead.
Hi, thanks for the opportunity again. So on Laurus Bio, we've seen a good ramp up on a quarter-on-quarter basis. So can you comment a bit on the margin profile of the business versus FY21? Have we seen an improvement now that the revenue run rate has picked up? And if you could also give some sense of the revenue potential once we have all the 4 new reactors up and running.
If you look at in the first half of current financial year, we have done 40 crores in Bio. And in the second half, we'll do more than the first half. That's for clear. And the margin is good, is very good. And we can't give you specific numbers because we are not publishing margins for the division-wise. This is very good margin business for us.
Okay. And the LSPL Unit 1, which we commercialized last quarter, how has the ramp-up been so far? And then should we expect FDA and other regulators to audit the facility in the near term? And then is the ramp-up really linked to these inspections?
Can you just repeat the question? The first one we could get very well, but this one we have challenges to understand the question.
So on the LSPL Unit 1 facility, is the ramp-up really correlated with the audits by FDA and other regulators?
FDA audits you are asking?
Yes, for LSPL.
You see, we had one virtual audit by FDA for pilot plant, which was concluded 2 months back, and they sent a satisfactory letter because they have visited, so they don't give an EIR. So there are no approvals pending from the site, and we don't have any pending inspections from FDA because last inspections we had in 2019. We don't have any pending inspections. None of our approvals or our partners' approvals were held because sites were not inspected by regulators.
Okay. And the last one from my side. So this subsidiary LSPL that we have created, will we be demerging our CDMO-related assets into this entity? Because we've talked about independent existence for this subsidiary. So just wondering if that is part of our priority.
We couldn't get the question, unfortunately, we can't give an answer because we couldn't get the question.
Can you repeat with closer to your microphone or you remove your speaker?
I'll try again. So LSPL subsidiary that we have. We've talked about this subsidiary getting into a stage of independent existence on its own. So will we be consolidating our CDMO-related manufacturing facilities under this subsidiary in the near to medium term? Is that something that we're looking at?
We are not consolidating. Whatever the new manufacturing infrastructure required for the CDMO business, we are creating in a dedicated site. CDMO already utilizes capacities which are already available with the parent. They will continue. It is not easy for us to remove one manufacturing from one side to another side for these molecules. So existing business, they will continue to use the parent's capacity, but new capacities are created exclusively for the division. I hope this answers your question.
Yes, understood, sir. Thank you very much.
Thank you. The next question is from the line of Charulata Gaidani from Dalal & Broacha. Please go ahead.
Yeah. My question pertains to, in terms of CDMO, what is the contribution to revenue that you expect going forward?
In the past 6 months, we have done 350 crores revenue in the CDMO. That is 15%. Yeah. So I think for FY23, we do expect it will be 15%, and it is going up. So we used to have 10% revenue, now it's went up to 15%. We do hope this business will contribute more from FY24 onwards. When we commercialize the new sites, this revenue, this division will start contributing more.
Okay. And how many customers do you have as of now?
We have a good number of customers from virtual to small biotech to big pharma. We have a good number of clients, and we are adding a few clients as well, new clients.
Okay. My second question pertains to FDFs. How many launches are you planning in FY22 and 23?
FY22, we will launch only one more in US, two in Canada. But FY23, we expect to launch 5 in US and 2 in Europe.
Okay. Okay. And are you witnessing any price erosion, especially in the diabetes segment and cardiovascular?
Formulation in cardiovascular is contract manufacturing, so we are insulated from the pricing. We also make API there. So in the diabetes for Europe also, it is mostly contract manufacturing. So we know at what price we produce API, and we know what price we produce formulations. So that's where we are fairly insulated from the price drops during the launch.
Okay. Okay. Yeah, all the best. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take one last question from the line of Jay Modi from Emkay Global. Please go ahead.
Yeah, good afternoon, sir. I had a question pertaining to debt. So from current level, should we see our debt level staying where it is, or will it be tending downwards from here on? Hello?
Yeah. So you're asking what is the debt level?
No, sir. I'm asking if from a current level of 1,800 crores, will we be looking to pay down debt or maintain at current levels?
It may increase slightly more by end of this year, but from next year onwards, it will come down.
Okay, sir. And what would be our current cost of debt?
Sorry?
Current cost of debt?
It's around 5%.
Okay, sir. Thank you. That's it from my side.
Thank you.
Thank you. I now hand the conference over to the management for their closing comments. Over to you, sir.
Thank you everyone for your insightful questions. And we wish all of you a very healthy and safe festive season and happy Diwali.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.